Glad you're here. Welcome to Modern Investing Techniques, episode 31. Today is April 30th, 2026. I'm Patrick, broadcasting from Vancouver. Time to break down today's market setup and find our edge. Quick reminder, everything we discuss here is for education and entertainment. Our practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Oil topped $126 on Iran tensions, yet equities stayed mixed, signaling the war is accelerating the shift to renewables. Markets ended mixed on Thursday. The TSX Composite closed at 33,318, down 0.8%. The S&P 500 closed at 7,136 flat. The NASDAQ Composite closed at 24,673, also flat. Geopolitical risks around the Strait of Hormuz drove Brent crude sharply higher. Investors digested stalled growth and rising inflation signals from Europe at the same time. Canadian investors should watch today's StatCan GDP release for February and the first quarter early estimate. That data will set the tone for Bank of Canada expectations in the weeks ahead. Our successful TMUS relative value rotation from 16 days ago delivered 0.61% alpha. It serves as a useful template for precision over broad market exposure right now. While the broad indices were quiet, one theme is quietly being supercharged by these same headlines. The Iran conflict is accelerating the energy transition by exposing vulnerabilities in traditional fuel supply chains. When oil breaks $100 on war fears, the smartest move is often a thematic rotation into renewables, battery technology, and grid modernization. These areas benefit from accelerated policy support during commodity shocks. You can implement this on Questrade or Wealthsimple by screening for thematic exchange-traded funds with at least 60% exposure to solar, wind, or grid infrastructure. Target a 5 to 10% allocation inside your TFSA or FHSA. Confirm the trade with 20-day average volume to ensure real conviction behind the move. This approach showed 15 to 25% outperformance versus broad indices during the 1970s oil shocks and again in 2022. The main risk is a rapid de-escalation that removes the urgency premium and produces 10 to 20% drawdowns. Remember, when oil breaks $100 on war fears, the cheapest hedge is often ownership of what replaces it. This macro rotation theme is exactly why we are stepping into a rare midweek flash trade today. This is a simulated trade for educational purposes only. Our practice investment of the day is a flash trade in Bitcoin. The catalyst is the most hawkish Federal Open Market Committee tone in years, combined with oil at 4-year highs. That combination positions crypto as an attractive inflation hedge. We verified the reports across multiple providers before acting, which is now standard discipline for us. Technically, Bitcoin is holding above its recent consolidation on the daily time frame. Volume is above the 20-day average on upticks, giving us decent confirmation. This is a same-day flash trade with medium confidence. Two factors are aligned, but macro uncertainty around further escalation remains. We are using a 6% hard stop to keep risk defined. The target is 2 to 5% higher if momentum carries toward the $75,000 zone. This teaches cross-asset macro scanning and the importance of multi-provider verification. It also helps busy professionals avoid pattern day trader flags or TFSA over trading concerns. Before we get to the education segment, let us close the book on yesterday's trade. Our simulated position in EXE delivered a gain of 1.88%. That works out to $18.76 on a $1,000 notional. The NASDAQ was flat over the same window, so we captured 1.88% alpha. The merger scale advantages were not fully priced in despite the catalyst. Portfolio now stands at 9 trades with a 44% win rate. Cumulative profit and loss is negative $22.80. Year to date, the portfolio is down 0.25% against the NASDAQ, up 6.19% for negative 6.44% alpha. Rule: cross-check all binary catalysts with at least 3 independent news sources. These results perfectly illustrate the fee and behavior drag we are about to explore. Imagine you received a $3,000 tax refund yesterday and split it evenly between 2 ideas. Half went into a 0.03% management expense ratio S&P 500 exchange-traded fund. The other half went into an actively managed energy transition fund riding the current oil surge narrative. That active fund carried a 1.15% management expense ratio plus 0.45% in trading costs. Over 15 years, the fee gap alone destroys roughly 22% of the compounded return even before any manager underperformance. Spiva data shows approximately 88% of active equity managers underperform their benchmark over 15 years net of fees. The mechanism is pure compounding arithmetic. Higher costs create a permanent 1 to 2% annual headwind the manager must overcome just to match the index. What catches most people is that the decision to go active is often triggered by recency bias right after headlines like today's oil spike. You chase the theme at exactly the moment institutions may already be rotating out at higher costs. The core rule is to keep at least 70% of your TFSA and RRSP in passive indexing. Use thematic satellites for no more than 30%, and only where you can document a clear, verifiable edge that exceeds the fee drag. With that framework in mind, here are 2 tools that help retail investors act on it. The Motley Fool platform delivers institutional quality fundamental analysis on Canadian compounders. Start with their free screener to identify names building diversified Berkshire-style portfolios of operating businesses. The paid tier runs about $99 per year and gives full reports plus real-time alerts. It is particularly useful for TFSA investors looking for names that survive multiple market cycles. The account structure optimizer available through interactive brokers or Questrade calculators is equally practical. Input your province, marginal tax rates, and expected longevity to optimize TFSA, RRSP, and spousal contribution splits. 15 minutes once per year can save thousands in unnecessary taxes over a decade for couples. While we are on the topic of targeted exposure, here are 4 quick hits worth your attention. Toronto area high-speed rail may get 2 stations instead of 1, according to the Alto chief executive. That expansion would materially increase project scope and associated contracts in construction, engineering, and transit technology. Add the Canadian Industrials Exchange traded fund ticker XEI to your TFSA watch list for potential near-term contract flow. Eurozone inflation jumped to 3%, while first quarter gross domestic product expanded only 0.1%. This raises stagflation concerns and complicates European Central Bank policy. Reduce Eurozone equity exchange traded fund weightings by 3 to 5% in global portfolios this week. China blocking Meta's $2 billion artificial intelligence deal on national security grounds serves as a cautionary tale. Beijing ordering the unwind illustrates escalating regulatory risk for cross-border Chinese tech transactions. Trim any China-based artificial intelligence names to under 5% of your growth allocation and redirect toward North American equivalents. The federal spring update targets apprenticeship funding to close Canada's skilled trades gap in infrastructure and energy projects. Consider Canadian industrials with strong training pipelines for fresh TFSA capital this month. Take last year's tax refund or a reasonable estimate for this year and open a 10-year compound growth calculator. Run the numbers at 7% inside a TFSA versus a taxable account and note the difference. Then set a calendar reminder to contribute any refund directly on receipt. The whole exercise takes under 12 minutes and turns the passive versus active fee discussion into concrete personal numbers. Before we wrap, I have my eye on energy transition names that could see fresh policy tailwinds if today's GDP print comes in soft. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.